markets, especially interest rate markets, are nothing but confidence games. And if you chip away at the erosion of the confidence in the market, look, Biden, for example, made a catastrophically bad decision when the war broke out between Russia and Ukraine. The freezing of Russia's assets. That meant that U.S. Treasuries, for example, are no longer neutral. Whatever your thoughts on the war, or Putin, or again, just as an analyst, that is bearish for the future role of U.S. Treasuries as a neutral reserve asset.
Hello and welcome to the show. I'm your host, Alex Daley. If you have ever wanted to know what a green cartoon chicken thinks of the stock markets, here's your chance. We're joined by the team behind the pseudonymous Doomberg, one of the top finance publications on Substack. 2-1. They've built a reputation for a data-driven, clear-headed analysis of energy, policy, and the markets overall. If you're looking for a contrarian viewpoint that challenges some of your takes on the market, look no further. As always, nothing in this interview constitutes a recommendation or personalized investment advice. We make these videos for educational purposes only, and the views are those of our guests. If you enjoy interviews like this, click that like or subscribe button. Welcome to the show.
Alex, great to be here. Looking forward to it.
Now, you guys are really focused on the energy markets. I think you're saying around your blog is energy is life. Can you expand a little bit on what you mean by that and why you use that as a lens for your investing?
Yeah, one of the great mysteries of our time is why so few financial and geopolitical analysts all but ignore the energy question. And we have found, and I think our growth has been predicated on the fact that using energy as the primary foundation for financial and geopolitical analysis is really, really effective. We came up with the phrase energy is life as a reflection of the foundational fact that the human endeavor is a constant, unrelenting struggle against the forces of entropy. Disorder is spontaneous. Right angles do not spontaneously occur in nature. You have to feed energy. You have to waste heat in order to impose order on any local environment. And your standard of living is literally defined by how much heat you get to waste doing that. So energy is life, and the absence of energy is death. Humans are literally machines that require fuel. And every aspect of modern life that is beneficial, that extends life expectancies, increases standards of living, begins and ends with energy. And so be it geopolitical risk, likelihood of global conflict, likelihood of recessions, likelihood of booms, if you begin your analysis with energy, you're already far ahead of most analysts, investors, advisors, and so on.
As a former engineer myself, I hear what you're saying, right? The laws of thermodynamics apply to everything, including our ability to run AI and the internet and all the things of our modern conveniences. How do you translate that down into your view on the markets, though? What do people get wrong when they don't apply this sort of energy first view to the market?
Yeah, so the first thing that they get wrong is they treat energy commodities in the same way that every other increment of GDP is treated. And so that's a foundational mistake. And in fact, everything in the economy is built on the foundation of energy. And if you take away the energy, the entire edifice collapses. And so no, financial transactions are not the same as drilling for oil. They just aren't. And that leads us to the first question we ask ourselves, what's on my Bloomberg launchpad every day? When we open it? Well, it's an assessment of the state of the energy markets globally. There are certain correlations that give you a very good idea of where things should be, and also highlights potential arbitrages that eventually have to close, which can give you, that 55-45 type edge that everybody is looking for. It's not right all the time, and sometimes you get the timing wrong. But when we look at the markets every day and we see calm, well-supplied physical markets, first thing that you know is there's not some major firestorm being priced into the markets, for example. I could give you a couple of those rules of thumb if you're interested, just to sort of give you an idea of how powerful such analysis should be.
Yeah, please share a few of the indicators you look at and maybe where they are today.
Yeah, so first thing we look at is based on the fundamental sort of physics of the fact that there is 5.6 million BTUs in a typical barrel of oil, and natural gas is priced in dollars per million BTU. So if you multiply the price of natural gas by 5.6, you get the price of natural gas in barrels of oil. And one of our rules of thumb is that landed LNG in Europe should trade lockstep with Brent crude European crude if you multiply the landed price of LNG by 5.6. And you see that today. So if landed LNG is, $11 a million BTU, Brent crude is in the low 60s. And when you draw like the 90-day chart of those two, you just multiply the landed LNG by 5.6. They trade in lockstep. And if you see significant deviations, that means something's going on in the market. And we saw that, for example, during the energy crisis during the early days, where the price of LNG skyrocketed. Intraday high, I believe, touched $100 per million BTU, which is $560 a barrel oil, which tells you that there's a massive energy crisis going on around the world. Another thing that we look at is the delta between WTI, West Texas Intermediate, and Brent crude. They typically trade in lockstep with each other. Brent's a little higher. If we saw a significant deviation from that, we would, depending on which way it deviated, one of the things we were looking for during the Israel-Iran 12-day war was a spike in that differential, because if the strait was closed and huge amounts of supply were knocked offline, we believe that Trump would have limited exports, WTI would have gone down, and Brent would have skyrocketed as the rest of the world bid up whatever increment of oil is not in the US. At the same time, that LNG Brent spread stayed pretty stable too. And don't forget, Qatar's on the wrong side of that strait. And so if there was truly a threat of closure, we would have certainly seen that one spike as well. And we did not. During that crisis, we were able to say the energy markets are not pricing in a closure. They're pricing in a little geopolitical risk, but they're not pricing in a closure. The last thing I'll say, we have other indicators. I'm happy to talk about them. But as a general rule, we conclude that the equilibrium price of oil should be around $56 a barrel today, like in the current era. Who knows how it will evolve over time. And we arrive at that number because at $10 a million BTU landed LNG, everyone in the US natural gas supply chain can earn their cost of capital. And so when we look at the price of natural gas in the US, you can correlate all these things. So the price of coking coal versus the price of thermal coal, all manner of things that you could look at. And today, broadly speaking, during this period, the energy markets are very well supplied, and the correlations that we would expect in the market are stable, which means that there's nothing on the horizon that is really disturbing the markets today. And energy prices are very, very cheap. All things being equal, that would be conducive to strong economic growth.
Yeah, I think oil prices have been something that retail investors, at least I've heard, scratching their heads about a little bit. We have a lot of geopolitical instability. We have tariff question marks hanging over our head. And as you said, you're saying that at $56 a barrel, which, oil's trading around 60, I believe, especially WTI here in America. Why are we seeing such low oil prices when traditionally we've been conditioned that high geopolitical risk, lots of wars, especially in the Middle East, Ukraine, Russia, those kind of areas, have historically driven up oil prices?
Okay, so there's a big misconception amongst energy investors that I'd like to address. They are seduced by the inelasticity of energy, right? The inelasticity of demand for energy. And so occasionally we see these super spikes in energy, like we saw during the energy crisis in Europe. But broadly speaking, the long-term price of all commodities, the long-term real price of all commodities is lower because the commodity companies are deflationary machines. And if you want to prove this to yourself, don't plot the long-term price of oil in dollars, plot the long-term price of oil in ounces of gold, which is our proxy for real money. And you can see the grinding effect of technological innovation. Oil and gas companies are technological behemoths, underappreciated. If you visited an oil platform or an LNG liquefaction plant, you would be amazed. It would seem indistinguishable from magic, what occurs in these places. And if you look at the drillers in Marcellus, EQT, I think they're all-in break-even or range, or pick your favorite, like not to name any securities, but the leading natural gas drillers in the Appalachian basins, their break-even price of 12-month strip price is like $2.40 a million BTU, which is something like $13 a barrel of oil. They're just getting really, really good at this. And by the way, that means that we don't view commodities or even the E&P producers as necessarily attractive in the long term, because they're price takers and the price of their product is necessarily lower over time.
We've heard for a long time this idea that we're running out of cheap oil, right? That it would be more expensive to pull, say, tar sands oil out of Canada than it is to take, oil out of a well in the Middle East. What do you make of that? I mean, is technology just such a force that that's not
Yeah.
going to be true long term?
Well, one of our most provocative pieces in hindsight, most popular one, was titled "Peak Cheap Oil is a Myth." So you can probably guess where my answer is going. There's an enormous amount of hydrocarbons underground. Humanity has barely scratched the surface. This is where there's a couple of fallacies. These are normally put forward by people who are long the commodity or long the commodity producers. The resource base is defined by the total amount of hydrocarbons in a certain area. The reserves are an accounting term. A reserve is nothing more than a subset of a resource against which investment has been made to prove its technological and economic viability. That is an SEC term. It's not a physics term, and the two get conflated a fair bit. So we published a chart where we looked at the total US proven oil reserves as reported by the Department of Energy, plotted against prior year's oil production, and that number is 10 to 11 with a R squared of 0.99. In other words, the US always has 10 years worth of last year's oil production as reserves. The constraining factor to oil and gas production is today politics. There's an enormous amount underground. Geology is not constraining. There are pockets where maybe you deplete a field or two, but there's just so much oil and gas that our mental model, we like to think laterally, and we develop mental models. And one of our mental models, for example, is there's an infinite supply of natural gas. To build on this question and also to extend your prior one of the reasons why oil can't catch a bid is because there's an enormous amount of engine switching going on away from petroleum products like diesel and gasoline towards natural gas, because natural gas is very, very cheap. Land pipeline natural gas, let's just say it's $5 a million BTU in China. Natural gas coming from the power of Siberia. I don't know what those numbers are. It's just a hypothetical. That's what, $25, $30 a barrel oil. Why would you run your trucks on diesel if you could run it on LNG? And China's doing that, and that arbitrage closes. This is an example of why energy is so important. You could see that arbitrage. So China had a double benefit of doing that. Well, really a triple. It was cheaper. Natural gas burns much cleaner than diesel, and China, the Chinese Communist Party, is significantly worried about pollution in the cities. And China is pushing out electric vehicles at a rapid clip, which is diminishing the demand for gasoline. And so if you can take down gasoline demand alongside diesel demand, then you're kind of helping your refining base too. And China is the largest refining, has the largest refining capacity in the world. There's so much natural gas, and we know how to switch the engines. Like the engines that the world runs on today were set when crude was discovered, because it is imperative upon refiners to use every molecule in that barrel of crude. So gasoline goes to passenger vehicles, mostly diesel goes to trucks and delivery trucks, jet fuel goes to jets, and bunker fuel was burned because they didn't want to waste it, and even the roads, tar, it's still bottoms from oil refining. Every molecule that goes into a refinery has to go somewhere, because so many molecules go in that even a small impurity building up constipates the whole system very quickly.
Yeah, it's where we get plastic from too.
Yeah, 100%. Right. And so let's take the plastic example to show you how knowing energy can predict a trend. Ethylene is the most important chemical in the world. It's produced by a process called cracking. In Europe, the traditional ethylene crackers use naphthalene, which you could think of as a oily mixture. It kind of comes from crude. But in the US shale, they're producing natural gas liquids hand over fist. One of the most important components of natural gas liquids is ethane. And there's a whole array of new ethane-only crackers going online that are far more economical because they have less impurities to work with, but also they're just building them next to the shale patch. And so we've seen wave after wave of European naphtha refiners. I misspoke. It's naphtha, not naphthalene. I'm sorry. It's been a while since I've been in the industry. Naphtha refiners in Europe shutting down because they just can't compete. And there's a glut of polyethylene on the market today because there's just so much cheap ethane coming out of the U.S. shale. It's just a tsunami of hydrocarbons, right? And so when we have lots of contacts in industry, and you get a sense for how things go when you go to conferences and things like that. And like we talked to somebody who's in the natural gas business when we were writing a piece about how much natural gas there is, and his quote to us was, "I don't know much about gas except that we have too much of it." Right. The last thing I would say is you can actually make oil out of natural gas. The Shell Pearl facility in Qatar does this already. Chemists know how to make gasoline and diesel from coal or natural gas. The Germans had to do it in World War II. The South Africans had to do it during the sanctions era. You wouldn't want to do that, but it puts an equilibrium price on oil because you could. So let's just say the break-even price to turn natural gas into gasoline and diesel is, I don't know, let's pick a number, $6 a barrel. Well, if oil spikes to 200, guess what's going to happen? They're going to build a lot of these plants because they have a new arbitrage to go close. So understanding the physics of energy and where things should go gives you a real head start in your analysis, which, if done correctly, ought to be able to be the basis of some alpha.
You really point out well how technology, a force we think of, I think largely about driving Silicon Valley and innovation online, ending the oil and gas industry. Speaking of technology, where do renewables fit in all this? Are they becoming a replacement for hydrocarbons, or in this sort of deregulated Trump type world, has that fallen by the wayside?
Okay, let's partition renewables into two categories. Impoundment hydropower, the big giant dams with water behind it, and wind and solar. Impoundment hydroelectricity is a fantastic source of electricity. It has its issues, the environmental destruction that occurs, the displacement of peoples behind the dam. It's very controversial. Also, significant safety issues. Sometimes they collapse, and when they do, it's very deadly downstream. And the reaction to such collapses compared to the reaction of Fukushima is something we could talk about. But by and large, just from a grid operator's perspective, hydroelectricity is great. Why? It is both baseload, i.e. capable of operating 24/7, and highly dispatchable in the sense that grid operators can tune the supply coming from such facilities in a matter of minutes, and they are far better able to perfectly match supply and demand, which is one of the key inputs into operating a grid successfully and cheaply and safely. The last thing that I would say about impoundment hydroelectricity is it also provides significant grid inertia. In other words, the large spinning turbines that you find there and at coal plants and natural gas plants impart inertia onto the grid, which allows grid operators to ride out minor faults far more easily. Wind and solar fail against all of those measures. They are intermittent, which means they're not baseload and not dispatchable. And they are inverter-based resources. And so unless you make an enormous amount of concurrent investment when you bring new wind and solar onto a grid, you destabilize the grid. And we just wrote a piece on this earlier about what happened in Spain. A fault at a solar plant cascaded through the grid. The grid was operating with like 60% solar at the time. No inertia of consequence to overcome that fault, and the whole grid collapsed. Our view is that wind and solar are parasitic to existing grids. Wherever they are installed with high market share, they usually lead to higher prices. The one exception would be a place like Norway or Quebec, where they have a huge amount of hydro, and that can act as a giant battery for an existing grid. And so you can get a bit more penetration of wind and solar in the province of Quebec or the country of Norway because they just have so much hydroelectricity and it's very, very dispatchable. As a general rule, when intermittent sources pass dispatchable sources, things start to break. And coal is not really dispatchable, and neither is nuclear, but natural gas is really good, just like hydro, at dispatchability and being baseload. So once you know how grids operate, you can come to the conclusion that there's no real need for wind and solar. Look what's going on in France. Nuclear is baseload, but it's difficult to dispatch it. It takes hours to ramp up and ramp down, and they would rather not. These facilities are built to run 24/7 when they're at their best, when the electricity is cheapest, when it's predictable. And France had a beautiful grid, 70% nuclear plus or minus, the rest mostly dispatchable, hydro, natural gas, and so on. They started forcing wind and solar onto the grid. Things are starting to break. Maintenance issues with the nuclear facilities, etc. There was a move to limit new wind and solar while they figured this stuff out. It failed at some point in the parliamentary maneuvering. But whenever you see intermittency supersede dispatchability, you run into problems everywhere. China's running into problems. China has been building solar at an enormous pace.
Yeah, I was just going to ask you about that. I mean, haven't they been installing as much solar per year as the rest of the world combined?
That's every statistic about China in the energy market is that way, by the way. Like, they're also installing the most amount of coal in the world combined.
Yeah, nuclear too, I think, right?
Nuclear, right? And they emit half the world's carbon emissions or some crazy number like that. They burn 55% of the world's coal. But yes, they're installing an enormous amount of solar, and they're just now running into problems in that sort of double-digit range because they burn so much coal, and coal is not dispatchable. And so I could tell you with reasonable certainty that if they continue to install solar at this pace, they will eventually run into problems. And we noted with interest that suddenly there was an announcement that they're changing their pricing schemes, where solar will have to compete on the wholesale instead of power written to motivate the installation of new solar facilities. This is not surprising to us. I'll tell you a story. When I was in industry back in the late 2000s, there was a boomlet of wind power production in China. And this caused several little boomlets of the things that feed that value chain. One of them was epoxy materials, the stuff that goes into making the blades. And so there was a whole boomlet of wind going in, and concurrent with that, there was a whole boomlet of new epoxy plants built in China. All of the West sort of existing epoxy plants were enjoying that boom because they were selling into it. However, the basis of that boom was an interesting artifact of government regulation. It turns out that wind facilities above 50 megawatts were regulated at the national level. Below 50 megawatts were regulated locally. What you saw was a wave of like 49.5 megawatt facilities going in locally, and there was no superseding coordination of plugging these all onto the grid. And when enough of them were built, Beijing came in and put a halt to it overnight. And it just completely whiplashed the supply chain. And what was left then in the epoxy business was a vastly overbuilt capacity, and it crushed the existing players, especially in the West, for years after that. And it just goes to show you how crazy things can happen without forethought, even in countries as sophisticated and well-planned as China.
Yeah, we say often on this show, right, the old Charlie Munger expression, you show me the incentives, I'll show you the behavior. And it sounds like what you're saying is some of these politically driven incentives around renewables have driven some very strange behavior. Is that right?
Yeah. And by the way, armed with such knowledge, at least you have a starting point to say, well, that can't go on for much longer. So if we look at Chinese solar, if we're right, and we could be wrong, full disclosure, full disclaimer, but our sense is because they have so much coal, they can't put too much more solar without breaking a few things. And so if somebody gave me a broad pitch about getting along something that depended on continuing growth of solar in China, I would be skeptical. I'd have questions to ask. I would need to be convinced. You see, this is where you get to feed that analysis process with physics, and it gives you a basis to start asking such questions. Okay, tell me, how strong are those contracts? I mean, are you worried about, and so on. You can imagine the questions you would have after listening to this discussion. It happens all the time. And by the way, last point I would say, Trump's reemergence is actually very bearish in a way for the energy sector, in the sense that the whiplash, take the wind industry, as critical as we are, just call them parasitic, it is patently unfair what happened to the wind sector. They went from the US government demanding they install 30 gigawatts up and down the US Northeast and give them all the incentives in the world to do it, to Trump comes in and with the stroke of a pen, entire cap tables were wiped out because of politics. And the reason why this is dangerous, even for the oil and gas sector, is the capital planning and execution cycle of heavy industry is longer than the US political cycle. And that makes investing in the sector more expensive. Premiums have to go up. The cost of capital to all players has to go up. So that's just another interesting observation.
Yeah, political stability. I think people forget how important stability of the courts, the stability of the political system in the U.S. has been for long-term capital investment. That's an excellent point you make, right? As we get more fickle and more extreme, it becomes harder for people to plan a 20-year nuclear project, a 20-year wind project.
Or to control interest rates. So let me give you another thing we've been pondering internally that we've not written about. Once a country starts arresting former presidents, it's very difficult to stop. And it very quickly leads to the point where whoever is currently president never leaves out of fear of being arrested. And the U.S. started arresting former presidents in 2023 when the Biden administration, through their proxies, had former president, now current President Trump. Whatever your politics are, whatever you think of Donald Trump and his behavior, and Joe Biden and his behavior, or Barack Obama and his behavior, Trump's posting stuff on Truth Social about having Barack Obama arrested and all of his key lieutenants arrested. Once you go down that road, Alex, that's whatever the justifications are, however good retribution feels, that's all fine. That's not what we're analyzing. We're analyzing what happens in countries when former presidents start getting arrested, because that's what's going on in the U.S. today.
Yeah, I've certainly had that same conversation internally with my more politically minded friends. If you're going to arrest this president, what's going to stop you from arresting that president? Right. It just becomes a war of that. And I think it began even a little before 2023 with all the prosecutions in New York and this and that when a president's subject to every state, in each individual state.
So trying to kick him off the ballot, all of that. And so it very quickly reduces down to single party dictatorships because you don't want to leave, right? And generally speaking, such sovereigns have difficulty raising in the international markets, right? More than most, because dictatorships are metastable and they can collapse very quickly. And so, not saying the US is dissolving into a dictatorship, but just making the observation that once you start, super hard to stop. And what does that mean for interest rates?
Yeah, that's a really interesting, intriguing question, right? Yeah, because interest rates move in very, very small increments to even small changes in perceived risk, right? It's not like you're a dictatorship or you're a democracy and you get one rate or the other. It doesn't really work that way. And cost of borrowing can go up. We just had recently Jerome Powell come out and say, the Fed probably is going to have to lower interest rates, whether that's data driven from weaker jobs reports or whether that's politically driven with Trump out there banging the drum. I don't think we'll ever really know. But what do you make of that decision? Like, what's its impact on the energy markets? And what do you make of it more broadly?
This is another dangerous precedent that is being set, which is the politicization of the Fed. Again, you can argue when it started, but Trump firing Fed governors and investigating Powell over the renovation of the Federal Reserve building, just in isolation, these types of things will hold the potential to cause the market to question the independence of the U.S. Federal Reserve. And if markets lose faith in the independence of the U.S. Federal Reserve, all kinds of potential secondary and tertiary outcomes suddenly become more likely. And so again, Trump supporters can credibly argue that Jerome Powell has been incredibly political. Accommodate Biden's campaign, but keeping interest rates stubbornly high while Trump is president. That's what Trump certainly believes. That's what his team believes. And so what we're seeing is a concerted effort to use raw presidential power to essentially control the Fed. The analogy that we use internally is the court packing by FDR, which, regardless of the actual result, substantially changed the entire balance of powers between the judiciary, Congress, and the executive branch for decades. To the present day, Senator Mike Lee from Utah has a great book on some of the critical Supreme Court decisions that followed that were heavily influenced by politics, that have wildly distorted the U.S. economy compared to what the founders envisioned, like the abuse of the Commerce Clause, for example. That's just one of many that he points out in his book. And so what happens after Trump's attempt to pack the Fed, because it's essentially what he's doing, forcing people out so that he can replace them, browbeating Jerome Powell to resign early. There's all manner of monetary decisions that will flow from that. And again, markets, especially interest rate markets, are nothing but confidence games. And if you chip away at the erosion of the confidence in the market, look, Biden, for example, made a catastrophically bad decision when the war broke out between Russia and Ukraine. The freezing of Russia's assets is a decision that we loudly criticized in the moment, to much criticism, of course, because when you're in the middle of one of those war propaganda campaigns, pointing out a flaw on certain countries' sides, the one you happen to be living in is generally not looked upon too favorably. But when Biden and Europe froze Russia's assets, that meant that U.S. Treasuries, for example, are no longer neutral. They had before that largely served as a neutral reserve asset for the settlement of imbalances in international trade. But nobody can argue that Treasuries or European debt are neutral anymore because they've been frozen, seized illegally. Whatever your thoughts on the war or Putin, or again, just as an analyst, that is bearish for the future role of U.S. Treasuries as a neutral reserve asset. If you're a country that has ever been or might ever be in the crosshairs of U.S. foreign policy, you have to wonder about whether you should have so much of your excess reserves parked in Treasuries, which is one of the reasons why we think we've seen this run up in gold. And by the way, the same political whiplash of countries out of favor versus countries in favor only broadens that risk perspective to the outside world. Okay, Trump likes me now, Hungary might say. But what if Gavin Newsom wins in 2028? Central bankers around the world have to be looking at their portfolios of reserves and adding a political dimension to them now. One that is absent if you own physical gold and it's within your borders. And so these are the types of questions that would have seemed unfathomable 4 or 5 years ago. Arresting former presidents, seizing the reserves of a country as big and powerful as Russia, sanctioning countries, using tariffs as a political weapon. None of this is an investment in stability. I mean, that's no other way to say it.
Yeah, and we have benefited as a country from that stability for a long time, right? We were able to import goods and export those dollars and have the rest of the world hold them on their balance sheets, take our debt as their reserves. As you're saying, they have been sort of, de-dollarization, I think is the term I've heard a lot of people use, that all we've done with this weaponizing of the banking system is sort of accelerate the de-dollarization of trade. Are you seeing that reflected in the energy markets? Is more energy trading? Are we seeing more energy trading in renminbi and things like that?
Sure, there's a bit of a misconception about this. The actual currency used in the trade is not as important as what one does with the profits of the trade and where do they park it. So it's not a de-dollarization, it's a de-treasuryization. And Luke Groman, who's a friend and a great analyst who we read closely, we don't always agree with everything, but that makes him quite useful because disagreements are great starting points for reconsiderations. Letter Force for the Trees, highly recommend it. He's been saying for a long time that the sort of effort to move away from Western banking system, let's call it that, has been led by Putin and China. And we wrote a piece recently where we argued that World War III is well underway, and it started when Putin dumped all of Russia's treasuries and started buying gold, while concurrently China was developing the Shanghai Physical Gold Exchange so that they could basically price oil and gold. And a secondary effect of that is you open up arbitrage. And the premium in Shanghai is one of the things we look at on our dashboard. If gold is $30, $40, $50 an ounce higher in Shanghai, you can expect that gold might probably go up soon. Shorted in Shanghai, stand for delivery in London, and that puts a bid under the price of gold in London, and then you just deliver that gold to China and you capture your arbitrage. And there are many, many sophisticated players in the gold market that know how to do that. And so the sanctioning of Russia and the freezing of the reserves, all of this sort of flows, in our view, out of the the change in government in Ukraine. Let's be as apolitical as we can be. The color revolution that happened in Ukraine, all of that ripples to the present day. The formation of BRICS. Is it a coincidence that Brazil and India are key targets of Trump's tariffs campaign and their focus is on China and Russia? And by the way, South Africa is under the gun by the administration too. Like they've got the full alphabet. It's probably not a coincidence. And the alternative that BRICS is setting up is not a BRICS currency. It is a unified method for the settlement of imbalances in international trade. And if they have that, then they have escaped the tentacles of the Western financial sanctioning infrastructure, and the value of holding the reserve currency from the US perspective goes down significantly. And this is how we frame what's going on in the world. We note with great interest that it appears as though both Vladimir Putin and Modi are going to be in China in the coming days, and all three leaders are going to be meeting. And for decades, China and India have had a terrible relationship.
Absolutely.
They fought battles with each other over border disputes. The great paranoia of Western foreign policy was Russia and China ever getting together. At Doomberg, we have our letter, and then we have our Pro Tier. Our Pro Tier is a monthly webinar for our premium subscribers, and the one we're working on for September is tentatively titled Losing India, because India, both as a consequence of this war, the mini war that they had against Pakistan, and Trump's behavior around that war, and the 50% sanctions that Trump has levied on India, is driving them into the hands of China and Russia, perhaps irreversibly. And this is strengthening and unifying the BRICS movement as the countries that join it look around and say, well, if they could do that to Russia, or if they can do that to India, or they can do that to Brazil, they certainly can do it to us. And so that this is the real, we view World War III as the fight for the dollar. And last thing I'll say is, we don't use those words lightly, but one of the things we like to do is read everybody's propaganda, because we believe that allows you to get closer to the truth. If you just read The Economist, you'd have no idea what's going on in the world. And in the propaganda of many of these countries, they have been framing this as World War III since the war broke out in Ukraine. China thinks it's in World War III. Russia thinks it's in World War III. The U.S. has not conditioned the country that the U.S. is at war at all. It has sold the war as helping Ukraine recapture its lost territory and defend its sovereignty. And the U.S. is simply sending weapons, and Europe is simply sending weapons, which couldn't be further from the truth. This is a NATO war with Russia, fought using predominantly Ukrainian soldiers. And to frame it otherwise is we think, to deceive is too strong a word, but it blurs really important issues that investors need to know.
Yeah. So if I hear you right, you're saying people are sort of, underestimating the long-term global impact of these conflicts, of our use of the U.S. banking system as a weapon. This is going to have implications for a long time to come. Is that what you're suggesting?
Yeah, and look, the global South is what, 7 billion people? I mean, the G7 countries are an aging population of falling powers. And so, one of the things that concerns us, we did one of our pro-tier presentations last spring, all the way in April, where one of our main concerns was, how does NATO lose this war? Because we had concluded the war was lost all the way back then, but we actually concluded it was lost in December of 2023 when Ukrainian large counteroffensive failed to achieve its objectives because Russia beat it back. And so Ukraine could never win a war of attrition. One of our fears is escalation ends in nuclear. And so how do you actually losing wars is very hard. One of the many reasons why you should work really hard to never get in them. And accepting defeat is very hard. And it could actually disband the European Union. We're seeing enormous stresses in the EU today as a consequence of the expenditure of such treasure in an endeavor that didn't achieve its objectives. Is a huge political hole that has been dug. Political holes get filled.
Yeah, I've spent a large part of my career in the resource investing sector, both in mining stocks and then later in gold. And I've always found people who focus on the energy markets in particular have the cleanest view of geopolitics and what's really happening. So I appreciate you sharing sort of what you see happening, where the risks are. But one just sort of big last question for you, which is, what's a gal to do? What do you think is going to play out in the markets over the next few years? I know you can't predict things like, does someone go nuclear? These
Sure.
are black swan events, but take the black swans out. How are you positioning yourselves, and what do you think are the sort of likely big market outcomes of the next few years of these policies?
Sure. So here's how I personally run my portfolio, and the other members of the Doomberg team broadly run their portfolios as well. I personally own no individual stocks. I earn money in fiat. I exist in a fiat world. Doomberg subscriptions, whatever, what other business interests we have. I have to pay for groceries in dollars and tuition in dollars and gasoline in dollars. So I save by buying real assets, things that are inherently inflation hedges. So things like gold and land and collectibles that I enjoy and know something about and can make intelligent decisions on. And that's our savings vehicle. That is not an investing vehicle. So I personally don't even speculate in the price of gold. And then I invest privately. We invest privately where we can impact the outcome through our knowledge, our contacts, our view of physics, arbitrages that we might be able to spot, our ability to build a business with execution and discipline, to recruit good CEOs and so on. And we call that sweat alpha. And private investing is filled with all kinds of landmines. I like to tell my children they've not learned to date until they've had their first breakup. And we tell people who are interested in doing private investing that you haven't really become a private investor until somebody has stolen from you or you've experienced a few zeros.
So true. So true.
Plenty of donuts on the Doomberg asset sheet, I can tell you. But some home runs, right? And the whole thing about the private world is that you want a mix of risk. But if we can put our thumb on the scale, we find that we can compound our personal capital better than what we can do in the public markets. It also makes it much cleaner to write about Doomberg because we don't have any disclosures. So we like to disclose whenever we have any kind of a financial conflict. I personally own a fair bit of gold, but we don't view that as an investment, and we're not moving the gold market either, right? So, but last thing I would say on the commodity side, as a general rule, this seduction of the super spike gets a lot of money. It's kind of like buying vol, right? Oh, I think war is going to break out in the Middle East, so I'm going to get long oil, or I'm going to buy options in USO or something, some crazy idea like that. Our view is a great quote from Nassim Taleb, something to the effect of, all commodity shortages are followed by supply gluts. So you see that all the time. If you look at natural gas during the war in Ukraine, 4 or 5 months after the super spike, it was down like 80, 85%, some crazy number. 2009, oil spikes to 145 nominally, and like down 80% by the next year. So our view is if you have to trade commodities, and we don't, is that it's probably wiser to fade super spikes than it is to try to time them. So if we see a super spike, let's say the strait were closed and Brent blew out to 150. Pick a number, 15, 20%. Once it retraces that amount and it looks like the crisis is over, go crazy. It's coming down because there will be a supply response, right? Again, not investment advice, don't bet the farm on anything, all that jazz, but far better to do that than to burn vol waiting on the spike, because at least now you have knowledge. The knowledge of a spike has occurred and you have history to fall back on, which is usually, not always, such things regress to the mean quite rapidly. And if you do your own research and you convince yourself of such a thesis, then you watch the patterns and you see a super spike somewhere, then maybe you could embark on a trade. One thing that we saw that happened during the peak of the energy crisis that we just couldn't persist was the price of thermal coal was far more expensive than the price of coking coal, which is used to make steel, which had never happened as far back as our Bloomberg machine would let us plot. And we knew that arbitrage had to close. Like, that is a total artifact of the global scramble for stuff that can be burned to make electricity. And so just an example of, once in a lifetime type events, they're far better to react to than to try to predict, in our view.
I don't know about all of our viewers out there, but I always appreciate hearing a level-headed view of complex geopolitical, macroeconomic views. Someone who just takes the long view and says, here's what I think might play out. The struggle, always for me at least, is translating that into my own portfolio. What do you do when you walk away from a conversation like this to manage your own money? That's why we built WorthNet. We built it to help connect individual investors to seasoned investment advisors, firms that have spent decades working with investors to build plans intended to reach their goals, plans that take into account people's suitability for specific investments, like the private vehicles that Doomberg mentioned. If you're looking for someone to help you build your portfolio, to help you build your plan, just go to worthnet.com, click the Find Your Advisor tool, and get connected to one of our boutique, hand-selected independent investment advisor partners. Each of these firms were picked by us based on their track record working with customers and based on their focus on some of the challenges at the forefront of retail investing today. It's a tough market out there. Complicated macroeconomic situation, complicated policy. I encourage you, go to worthnet.com, have a consultation with one of our advisor partners, and who knows, maybe you'll find the partner you're looking for to help you manage your portfolio through these markets. I really always appreciate going to Doomberg.com and reading your guys' perspective, because you take such an engineering, level-headed, sort of historically based look at markets. So I want to thank you very much for your time today. I think this was a great lesson. As you said, nothing in this recommendation. We do this for education and perspective. It's not investment advice, but we thank you very much for sharing your perspective. I think it was great.
Yeah, appreciate it. And just a final comment, you can find all of our work at Doomberg.com. We are a widely circulated periodical, not a research outfit. We sell subscriptions, and this is the work of our lives, and we certainly enjoy doing it. And I really enjoyed the conversation, Alex. It was very fun.
Thank you. As always, if you enjoyed this conversation and you want to hear more like it, just click that subscribe button or that thumbs up like button on the video. That lets the algorithm know you want to see more from us and other sources like us. Also helps our videos reach a wider audience. Thank you very much for your time. Have a great day.